Hi everyone, I'm DeFi Dad. You're watching episode 59 of Yield TV. Hey everyone, it is Wednesday, January 13th, 2021. Today we will be interviewing Santiago Santos, who is a partner at ParaFi Capital. I've known Santiago as really another investor in the space for about 6 months, just following Santiago on Twitter. And I've really appreciated all the insights he's had. ParaFi Capital has been one of the few firms or VCs that has heavily invested in DeFi for more than a year. And that really caught my eye when I heard Santiago on the Delphi podcast about 6 months ago. So I'm just super excited to have you on, Santiago, and kind of dig into all your insights and expertise. So how are you doing? Welcome to Yield TV.
Thanks, Stephen. It's great to be here. Yeah, let's make it as productive and insightful and useful for your audience. I think DeFi has come to a little bit of a limelight. It's having its moment, but I think we're still super early. So very excited to be here.
Yeah. Let's dig into your background to kick off. How did you end up in crypto? I guess, what were you doing career-wise before you joined up at ParaFi?
Yeah, I think the evolution was really, I was at JP Morgan in their investment bank and really stumbled on Bitcoin. This was 2012. Reading a blog on Reddit of magical internet money. Being from Mexico, I said, well, this is interesting from a remittance use case because Western unions of the world charge 6 to 8 cents on the dollar for sending money back home. And it's a massive market. Talk about trillions of flows. And so I said, what if this Bitcoin thing actually works, where you're able to send Bitcoin to a number of people and they can convert that Bitcoin to local currency? You've totally disintermediated that big market that is candidly very inefficient, and there's a lot of friction. So I went out and bought a couple of Bitcoins, sent it to 10 people, and 7 out of 10 were able to do the flow. And so for me, that has always been top of mind. So after JP Morgan, I started invest. I was at a fund called SageView Capital, investing at the intersection of open source software and fintech. And so really investing behind this idea that finance is very inefficient. As it exists today, finance has a lot of friction, and there's a reason for that, because you don't have Amazon-like experience in finance because you can't move money the same way that you can move information in the internet. You need a trusted middleman to verify that you have a certain amount in your bank and you're sending it to another party. There needs to be some enforcement. There needs to be some verification. But as we know, the technology behind Bitcoin allows you to do that. And so when Ethereum came to being in 2014, I was early on, and I really was fascinated by the idea of introducing if-then statements to money. And when we think about like the challenges and problems that you have with finance and banks and institutions, is this idea that we end up trusting a certain company or a certain transaction or a counterparty, and that it is really just placing trust in that. And so as we know, history teaches us that trust can evaporate very quickly. You look at 2008 and the financial crisis, you look at just in other countries where there's rampant inflation. And so now you have the ability to have immutable code. And so there is a lot of certainty in how that code, that smart contract, will specify the flow of funds or a certain transaction. And so that's been fascinating. And really that is the thesis that we have here at ParaFi, which is, finance has a lot of friction, continues to have a lot of friction. And this will just become the operating standard of finance because it's faster, better, cheaper. So people may not necessarily care about crypto decentralization narrative, but I'll tell you what, they do care when you come and you open an app like Dharma or Argent, and it is just better. It just is seamless. It's faster, it's better, it's cheaper. And I think we're coming close to that state of the world.
Yeah.
So that's, yeah. So.
Why don't we go back like a year and talk about how are you explaining DeFi to your investors? And I'd love to recall, some of the conversations you were having then, and then let's zoom ahead to now and talk about what's the difference a year later.
Yeah, there's been a radical shift, I'd say. So early on, one of our earliest backers was Bain Capital, and they are very active in fintech. So I guess for them, it was less about making an investment in crypto. It was more, this could be the next arc of innovation of fintech. So let's just invest in ParaFi as a way to capture this emerging kind of fintech 2.0 or fintech 3.0, as however we want to call it. But nonetheless, it's just so they were more focused on the fintech element of it. Other investors were, have some familiarity with crypto and can be. I mean, not too long ago, people were saying, "Hey, don't you feel DeFi is just too narrow?" We look at the entire crypto market, like, and it's a very sexy narrative to start saying you can decentralize everything. So let's just reinvent the world as we know it. And we just take a more practical approach and say, well, no, let's just focus on what's actually working, because my view is that you don't actually need to. Most centralization use cases most things should not be decentralized, because the minute you decentralize something, you lose a lot of efficiency. So you shouldn't necessarily be decentralizing Uber or Airbnb. At the end of the day, you go to your host, you want to have someone to call. If you decentralize that, it's a little bit tricky. So, but when it comes to money, there's a lot of high stakes. And so so for instance, a lot of people are saying, well, this gas fees in Ethereum are crazy. They're going to kill Ethereum. I'm like, well, invert that logic. And isn't that a clear indication there's strong product market fit? People want to pay 100, 200 per transaction to interact in this decentralized permissionless system. We'll fix gas fees with layer 2s, no problem. But people are willing to pay for this. The same way that people were willing to pay for internet and cell phone service back in the day and paying exorbitant fees. Why? Because it fits a killer use case. And so anyways, I think some of our investors or potential investors we were talking to, or just generally in the market, were a little bit skeptical that DeFi was a thing. And look, it still is less than 5% of the entire crypto market cap. So it feels to me like Ethereum back in 2014, where there's a lot of activity, but somehow, and now in this case, fundamentals, and yet we're still a relatively small subset of crypto. But that's the opportunity really that we're pursuing here.
Yeah, I remember, I think Chris Berniski wrote a post, like it was probably in 2017, maybe it was like start of 2018, but he talked about J-curves in crypto and talked about the current utility value versus discounted expected utility value. And I mean, throwing aside like the words, I mean, all he was trying to say is in 2017, people's expectations of what you can do with Ethereum had gotten so far beyond its current capabilities. Now we've had the reverse flipped, and it's been incredible. I mean, like, it's such a better feeling to know that something is going to be in demand and to watch that demand grow, versus and I guess being able to exceed expectations. Like, I continue to find that narrative is true. It's very difficult to walk someone through some of the most basic DeFi applications, especially if they're crypto native, if they've had exposure to Bitcoin or Ether, and to not have them say, holy shit, I mean, I can do a lot more with my money now. There's a lot that I can do in a very passive way, just with like lending and interest. So tell me more then, Santiago, about what does today look like a year later? Like, there was obviously that need for you to convince them of what the future looks like, but everything has developed so rapidly over the last year. We had what TVL went from a metric that few people even paid attention to. I think we're at 600 million January 1st, 2020. That went up to like 20 billion, 22 billion. And then tokenized Bitcoin increased by 140x. That's the one that blows my mind the most. When people talk about it's not in value of USD, we're talking the amount of Bitcoins, which is a better way to measure that, increased by 140x on Ethereum. So anyways, yeah, what are those conversations like today?
Yeah, I mean, there's a lot to unpack there, but you're totally right. I mean, when we look at what happened in 2017 was sort of a capital raising machine where you raise a lot of money for an idea. Now you have an entire ecosystem that's called DeFi that has all these different protocols that interact with each other. Every incremental protocol that raises capital that is working creates a lot of synergies in the system. And so you're right, and now, you're able to do and make every asset that you have productive, whether it's stablecoin, whether it's Bitcoin, And I think you're right. The metric of Bitcoin is interesting because that is the minute you convince a diehard Bitcoiner to move his money to Ethereum, either through Keep or through a federated model like Ren or Wrap Bitcoin WBTC. Why? Because they want to make that asset productive. They want to earn some yield on it. And I think if you zoom out and say, well, what's happening in the world where you have record low interest rates? Your bank is paying you, a great meme, your bank is paying you effectively zero if you factor in inflation. Like the real rate is zero or negative. And then you look at the venture frenzy and people are doing these crazy deals that have a ton of risk like SoftBank, and they're arguably making terrible investments because they're chasing yield. In DeFi, you have very, very interesting ways to capture yield. Sure, there's a lot of risk, don't get 100%. And that is why the yield exists, right? But nonetheless, I mean, I think that has captured the imagination of a lot of interesting LPs that they may not be interested in Bitcoin, they may not be interested in Ethereum, but I'll tell you what they're interested in when you tell them, look, there's these DeFi protocols that are cranking out cash flow, and they're trading at a distressed multiple. Now, tell me how that's any different than you investing in Robinhood or Lending Club or some of these fintech apps that will never see the light of day because their unit economics are terrible. Meanwhile, you have Uni or Sushi or Synthetics or Compound Maker. I mean, literally the list goes on and on. These protocols are just cranking out cash flow.
Yes.
To me, that's the modus. Like our investment philosophy at ParaFi is, we're no better than anyone at predicting the future. To me, that's just a rolling the dice. Systematically, it's really hard to predict something. If you're early in Bitcoin, fine, great, kudos to you. You're early in Ethereum, you're early in Uber, but replicating that at an institutional scale is really, really hard. And I can't think of an institutional manager that has been good at replicating and predicting the future. Whereas we take a lot of stock in saying, well, what's working today? To Chris's point that you said, in 2017, you didn't really know how this was going to evolve. You could speculate that finance is going to be a thing, but there was nothing there. Nonetheless, today, you look at a very vibrant ecosystem. And it's hard for us to deviate from our strategy when we see all these fundamental metrics, whether it's TVL or flows like volume or users. And there's an incredible strength in DeFi and a clear, I guess, for the first time ever in history, you have the ability to interact with financial services in an untethered, unbounded way that transcends geography, jurisdictions, bullshit regulations, like accredited investor stuff. Like, I understand consumer protection is an interesting and very important thing that we should all focus in this space. Not everyone should be 100x levered and on margin. Like, I totally get that. Nonetheless, I mean, the access to basic financial services and investment products, you just have that for the first time ever. And so to your point around TVL, I wouldn't be surprised if we see 100 billion or even $1 trillion over the next couple of years, because money flows to the most efficient places. Like, money is very efficient. It will just find the most efficient. Liquidity is very ruthlessly competitive. So it will go from the most efficient places that you've seen in DeFi. But I think the biggest opportunity is really moving this whole behemoth of capital that sits idle in the traditional world that is, not earning anything, and as Saylor describes, is just like a frog in boiling water, is just sitting there and going to be inflated out. And at some point, you're going to want to port it over to this ecosystem called DeFi.
Gosh, there was so much there too that resonates with me. One of the things you mentioned is cash flows. So one of the criticisms I've run into with DeFi from friends that at least are crypto savvy enough but haven't dug into DeFi is they're like, hey man, if protocols are charging fees, I mean, aren't you just rebuilding the monster that is traditional finance? And I'm like, well, you have to look at what sorts of fees are being charged. I mean, we're talking with Uniswap, it's 30 bips. You have Sushi Swap, same thing. At the end of the day, I look at that. It's kind of like flipping the narrative, as you were saying earlier. And I say, well, to me, it screams sustainability. The fact that these protocols are in such high demand. And with these fees, those fees are enabling developers to be able to work, to improve the protocol, which also, is going to lead us to all sorts of scaling solutions like with Layer 2. And so it's something that it's different. It's kind of Like none of us want to say, oh, it's different this time and be wrong. But I'm like,
Yeah.
and
Look,
like,
I mean,
we don't understand the demand in this space.
yeah.
It's
I mean,
insatiable right now.
there's a common narrative around certain VCs that, or certain investors in the space that say, well, protocols that extract rent are going to be like, will not be sustainable. And I said, okay, well, one, that's dumb, because can you point to a single protocol that is like, that doesn't charge fees and is successful? Bitcoin needs it for its security model. Ethereum needs it for its security model. Like, call rent whatever you want, but miner fees or extraction, like, that is a form of rent. You need to excise rent for a system to exist, for the sustainability of any system. It is, sure, I get the analogy of Web 2, where some of these like standards like HTTPS and TCP/IP, like, okay, no fees accrue to that. I get it. It's like a common good. But making that extension to Web3, where you have the ability to accrue value in these base protocols, is missing the entire point, because you need some level of fees to interact with the system to incentivize all the different stakeholders that keep the consensus alive and make the system function. So we were very active in introducing a proposal on Wi-Fi to revamp the fee model, because we saw a rather kind of unsustainable model where some of the best core developers of Wi-Fi were not being compensated properly. And so at the end of the day, it's all about incentives. You need to incentivize either core developers or miners or whoever to participate in the system, and there should be a fee.
Yeah.
Now, I'm not saying it should be as high as certain other protocols. There is, I think, a balance, but saying that some of these protocols should all be just pure state transitions and no fees is kind of missing the point, because you're able to do that through tokens very efficiently, and there should be a fee because there's a value, there's a service that is being provided. So that's our.
Yeah, it's something I picked up on too. Just in the last few months, I kind of heard the rumblings of from some friends that, like, I think some of the Wi-Fi devs are really like, there's got to be a better model there. And this is the part of DeFi that I appreciate the most, especially not having a traditional finance background as a career, is I'm seeing everything develop so rapidly. I'm seeing like what I would expect would take sometimes years to happen in traditional finance happens sometimes in a few months. And fortunately, because of the way DAOs work, I think the community is able to quickly react to try to solve these new problems. Santiago, I had a question though about, there was something else you mentioned earlier. Who do you think is the lowest hanging fruit in terms of capital that's yet to enter DeFi? We were talking about like Michael, I think, is it Michael Saylor that said like a frog boiling in water? One of the many analogies that guy has made, which seemed to resonate with a lot of people.
Yeah. I think it's really traditional financial institutions that will operate in DeFi that I think will start playing in the system. And I'll tell you why, because they are perhaps the most motivated of the group. If you look over the last couple of years, the biggest cost driver of banks, it continues to be compliance and administrative functions, which candidly can just be expressed and solved for through smart contracts. And I think, it's always, when I look to make an investment, it's like, okay, well, are you solving for a cost driver, right? And I think DeFi fits itself into COGS line item of a particular bank, where they might have to hold Ethereum to interact in the system, which I think we'll start seeing Ethereum in balance sheets as an inventory, as an asset, but also as a cost item to function and play in Ethereum. But nonetheless, I mean, a lot of these functions can just be compressed, right? When you talk about, so let me give you an example. Say that you're an originator. Say you do mortgage origination. Well, you have to do all this paperwork and hire all these people to do all this paperwork and manage these loans and do all this verification. And so all that process takes 5-6 days. By the time you, DeFi dad, want to buy a house in Boston or whatever.
This is real.
This is real. You have to go to a bank
and
you submit all this information, which is fine. And then they probably take 1 or a couple of days to give you a quote. And then you have to do that process over and over to compare quotes. In 15 seconds, by the time I ran, you could have gone on Compound, deposited some assets, and then taken out DAI, and then sent that back to Coinbase, and then put the money down. and you could show the verification, traceability, the provenance of those funds, so it's KYC compliant, like that, you know where that money comes from. By the way, it's more transparent than cash or the financial system. So it's like any criticism around KYC and AML is unfounded. And you could just deposit that in a day. And you could compare rates through Aave, Compound, and every other protocol out there. You could do it fixed, you could do it variable, you could tranche it, you could rehypothecate, you could do whatever the hell you want. And so they'll start feeling the pain when you, like, that allows a bank, if a bank is say that JP Morgan were want to like totally streamline this mortgage process. They know your wallet address, they see you're on Compound, they could interact and in this system, in this money market, and then issue a loan on chain. That allows them to increase their throughput of origination orders of magnitude, right? And that means more fees to them. So ultimately, I think like DeFi as it exists today has been experimental. It's been kind of on the fringes. It's been testing a lot of things that work, that may not work. And I don't think we've still seen like the best of it all. I think we're still very early. But these banks will start interacting with trusted pools of liquidity in Aave, in Compound, KYC pools. I know your wallet address that's tied to an off-chain identity, and then I can give you a mortgage on chain in 10 seconds.
Yeah.
That just increases their bottom, like that increases profitability orders of magnitude. So ultimately, I like to think in many ways, like if you remember back in the 90s, like there's a lot of talk about that's an internet business and a non-internet business. Today, we kind of still make this distinction. Oh, this is a crypto business like Compound and Aave and Dharma and Argent. And then there's non-crypto businesses. That distinction, that line will be blurred away over time. As I think DeFi, this idea to interact on chain through smart contracts is just going to become an operating standard in finance in certain use cases. So I think that's like a very big contingency. I think like traditional banks, financial institutions, and then of course there's another subset of the level of institutional capital that wants to invest in this space is unlike anything I've seen before. I think the CIO of Abra aptly described this when there was a dip over the weekend. He said, these dips get bought out by, it's like a hungry farmer after being all day in the fields comes back and wants to eat a biscuit. and you know, BlockFi saw a 2x increase in volume when we saw the dip 2 days ago. You saw PayPal volumes are through the roof, 2x volume. You have, and like I think Coinbase is really ramping up in terms of just they can't handle all the institutional interest. So, you know, I think these are sequential waves of how capital enters crypto. The first it's perhaps Bitcoin, and then it's Ethereum, or then you just leapfrog the entire thing and just go directly to DeFi. But I think the more logical sequence is people want to capture yield. This is an investable asset class. It's a macro hedge. It has certain narrative and properties. And then that really is kind of the beachhead to then start saying, okay, what else can I invest in? Because everyone goes through this journey. Oh, I have all this Bitcoin. Oh, you tell me I can earn yield in Ethereum? Oh, well, tell me more about that. You know,
I just went through this. I had you know, mine are more with retail investors, but I was talking to my father-in-law who is pretty tech savvy for someone who's around 70 years old, and he has always found crypto fascinating just because I'm his son-in-law and I talk about it, but he had never actually invested. And I mean, that the conversation was as simple as you explained. He's asking me like, you know, if I were to get a little bit of Bitcoin or Ether exposure, you know, how would I do that? And I'm like, you know, quickly explaining, well, you go custody route, or you could use DeFi wallets the way I do. And at the end of that conversation, I was like, well, see, the thing is you don't just have to hold this. I mean, if you're going to hold it, you might as well lend it and you'll earn interest. And he's like, what? I can earn interest on it? Yeah, well, you can like, you know, earn low interest. Like, I mean, you know, depends if you go with like Ether and it's in DeFi, like maybe 1% if you're lucky, but there's other ones that are like, I don't know, 10%. And he's like, 10%, you know, or in terms of like, let's say BlockFi, 6% in Bitcoin. And, you know, he's like, do you know what I'm earning with, I think it was like Bank of America. And I'm like, oh, I know, it's a talking point, you know, amongst us. Mm-hmm. And the light bulbs go off. So one of the things that I was always anticipating, but didn't realize we're kind of already there, is that institutions, high net worth individuals, retail investors, everyone is going to be looking at that same opportunity saying, well, I don't want to hold. I mean, I want to earn, with what I'm holding. And it's a no-brainer. It's just, it's something that, obviously institutions, high net worth individuals, I think understand this more, but I've been amazed at how like retail is picking up on this, that like there's all this opportunity there. Anyway, I could go on and on about that, but
I think just to add to that quickly, one of the most important metrics that we monitor is stablecoin flows and activity. I think that is really the Trojan horse in a crypto that is going to really push us in the sense that once you get airdropped Libra or DM as it's called now, or a central bank digital currency, or just USDC Paxos, you get paid in that or what have you. As soon as you get that, it forces you to go through the journey of saying, okay, I need to understand how these wallets work, or maybe it's custodied in my bank. What do I do with this? I want to make this a productive thing, right? People don't like to sit in cash. This is the thing, like, I think ultimately you see these macro shocks, right? That people sell into cash because they're worried or what happens then? You give it 2 to 3 months, and institutions and just traditional investors, as soon as they sit on cash, it creates an anxiety of saying, how am I going to invest this again? And I think that is really the conversation now where I think ultimately a lot of these different stablecoin variations will open up this idea of asking what your dad just went through, which is, what do I do with this? How can I blend it, make it productive, earn interest on it? And that's where I think there's been incredible progress over the last year and a half of folks like you guys, Zapper or Argent, that have abstracted away all the complexity or most of the complexity of interacting in this kind of wild forest, which is going directly on chain on Etherscan is not for everyone, never will be. But I think we're at that point where the UI UX of some of these applications mirrors some of these traditional financial applications, and so that is especially with layer 2, something like Synthetics L2 is beautiful. Like, there is no distinction between, I may not necessarily know how it works or care, but I certainly can, like, it is very native and intuitive for me to go on Quenta or some of these, like, Zapper, and just it's no different than what I'm used to. And so that is that is very promising, I think.
Yeah, I mean, I used to when we lived in the Bay Area, an analogy I would use with friends was so like we would be talking about DeFi or crypto, and then they're like, yeah, but then how does this work and how does that work? And I'm like, when you cross the Bay Bridge, do you ask like, who is the architect? Like, what were the physics behind all of this? No, you just cross the fucking bridge because it works and it's fast. And so that's how DeFi is.
Well, like, I'll tell you what on that, right? We've all gone through this journey. Thanksgiving, Christmas, all these holiday events are there's just so much anxiety because, oh boy, I need to fucking explain crypto again to a bunch of people, and they start asking admittedly important questions. It's like, well, what gives Bitcoin value? Well, what gives Ethereum value? And you're like, well, there's a set of people and miners and people that think that this has value, and they dedicate resources to mine it, and ultimately it's consensus, it's trust. That everything in this world is all consensus driven, in a narrative and in a consensus. And they're like, and they take object, they're like, well, what happens if they all wake up one day and they feel that there's no value in Bitcoin? You're like, that's possible. It is possible.
Yeah, it is. Yeah.
It is still possible that happens. And you're like, but have you thought about that for the US dollar? What gives dollar value? Well, it's the US government. What gives the US government? Well, it's our law enforcement, it's our military prowess, we're the most dominant country. So what if that changes? Empires fall every 100, 150 years. What if that changes? What if one day that no longer holds true? Yep. And I think Americans don't realize this, but I'm from Mexico. I've traveled. Anyone that has traveled and studied history understands that empires fall and trust degrades and it evaporates, not gradually. It takes one spark. And look, we've been close. I went for a long time. I lived in the U.S. I thought I would never say this, but the U.S. is no longer what it was 6 years ago.
Yeah.
I mean, the headlines that we've seen is crazy. People going to the Capitol Hill. Like, I just can't. it is almost like I'm in a dream that I'm like, this feels to me like I'm watching Mexican TV, but yet teleported in DC. Something's wrong with the world, you know? But nonetheless, like going back to the more important point for this conversation, because I don't like getting into politics, it's more, I'm glad that people become more skeptical of how things work in their crypto journey. I don't think that's a bad thing, because then you start realizing, and then it's like, oh, okay, yeah, maybe I shouldn't be trusting my bank. Yeah, maybe Venmo freezes my assets at will. Why does that happen? And so, look, there are trade-offs in interacting in crypto. There is a lot of risk. There's a lot of responsibility at the user level, of custodying assets, of owning what you have, and not delegating responsibilities. Maybe something, a very intuitive flow like what you guys have helps in that, right? But still, I think it is a journey. That's, I think, at minimum, if this thing doesn't work, at a minimum, it just introduces a healthy skepticism in the world of how does money actually work, in the financial system actually work, and trust in institutions. Maybe we shouldn't be placing all this trust in institutions or our banks or Twitter or Facebook, or like, I'm not an anarchist, I'm not a crypto punk. I'm just, a healthy dose of skepticism goes a long way, I think.
And it's been a radical year for anyone who has a healthy dose of skepticism, because I mean, we've seen all these stress tests, and obviously a global pandemic, and then I guess watching like the amount of money that's been printed across the world, but obviously like the U.S. dollar being the global reserve currency, it's been insane to watch that. There's that one chart that everyone references, the
Two chart, yeah.
Yeah, and you watch that and you go, "Whoa!" Like that's insane to look at. And then, it's hard not to connect the dots and look at. Well, it was both Bitcoin, Ether, really like all crypto prices. Everything was up during all of the chaos happening in Washington D.C. And I think like for a while there's been more and more people hedging against that. I know I've had more friends and relatives in my life in the past year that have asked about like, so crypto, like, this is kind of like opting out, like, so because they're looking at their Bank of America account and they're worried about the fact that people couldn't withdraw money. I've never in my entire life seen people withdraw money the way they were back in like March. People were actually worried about there being enough money in cash, and so, anyways, all these sorts of things we've all kind of hypothesized. It could happen. It could happen. It could happen. Feels like it's been a year of like, wow, it happened. It happened. It happened. And it's laid the groundwork for like where we are. So like, what is different about 2021, 2020 compared to 2017? Why is it different this time around?
Yeah, definitely. I think, look, it's important to underscore, like, there will always be speculative manias. It happens in any market. That is not specific to crypto. There is always a time where the market pendulum swings to extremes, panic and euphoria, and it strays away from actual progress, innovation, fundamentals. And that is sometimes fine, where you needed to have perhaps if we didn't have 2017, we wouldn't have been here today, because 2017 allowed certain protocols to really bootstrap and raise maybe too much money, but nonetheless, enough money to survive through a bear market. And I'm not dismissive of that. I take optic perhaps that sometimes you shouldn't be raising $263 million. But it is helpful. What you do with it, I think, is helpful currency and energy to support an entire company and developers. So yeah, look, there will always be booms and busts. There will always be like cycles. That happens in any market. That is human psychology. I think what's different this time around is you have an entire productive system called DeFi that allows you to do really interesting things with your capital: saving, borrowing, lending, insuring. Like, there is, I think this idea of investing behind things and having a fractional share of ownership in Visa-like networks that are being very productive. And so I think it's this economy, right, that is very tightly integrated and composable, that allows you to do really interesting things. You can deposit your ETH in Maker, mint DAI, and then use that DAI to invest in or buy a token on Uniswap, or convert that to synthetics or SUSD, and then or buy some synths that represent a tokenized like a derivative. It could be Tesla or a broad exposure,
Yeah.
like buy DPI, which is exposure to DeFi. And so there's all these categories that I think you didn't have in 2017, right? And so I think in 2017 it was sort of like a black box of entropy where you just funded an ICO and you prayed something good would come out of that. I think there's certainly great projects that came. I mean, Haven, then now Synthetics, which is perhaps the greatest
Yeah.
bit of all time that I've seen. I was part of that. I've been amazed of the progress. Testament to the really just the resiliency of the team.
You were
no different.
Haven, like, so before FedEx.
Yeah. Well, I'd
Wow.
invested in Haven, and then just became close with Kane and Jordan, and saw literally the evolution of a pivot that at times didn't feel as obvious as it is today. And I think ultimately, as we think about investing in this space, you really just want to invest in people that are going to see it through. And that's Sonny, that's Kane, that's Hayden, that's Robert, that's a number of other, Andre, that's a number of people out there in the space that just, the space is not easy. I sympathize with founders because they, as Kane said once, if you haven't been called a scam artist once by someone in the community, then you haven't probably put yourself out there too much, because, this is the way these things work. But I really respect these people that have been building for the last 2 years through a brutal bear market. And now you're seeing, I think, the early fruits of this entire ecosystem that is quite fascinating.
Yeah, I want to liken 2017 and 2018 and part of 2019 to it's like me going online and wanting to buy something on Amazon. I'm buying like a few items, to 2020 where I'm like totally reliant now on Amazon to buy groceries because I didn't have the option to go into stores for a while. And it's that pivot of it's a peer-to-peer bankless financial infrastructure that is now digital first. I never interact with my bank. I have a bank kind of as like a backup, and it's obviously a fiat on-ramp and off-ramp for me. Well, the exchange, I guess, really is that. And that's how much of a pivot there's been. Like, that's what money goes in, and it doesn't come out because we're all gullible fools and would never pull it out. It's because there's so much I can do. That's another way too, even to explain like what's happened is I cannot do what I do in DeFi. If DeFi went away, I don't know what I would do. I would be very distraught. And we're talking like fantasy wise. Wave a magic wand, I'd be like, I mean, I would be left with nothing at this point. Like it's provided so much opportunity for everyone globally to connect. And that's nuts, because all of us are exchanging value, interacting in this new finance infrastructure. And you forget that, like, for example, you're in Mexico right now. I'm in the United States. Stani's in Finland. Kane's in Australia. There's a DeFi group in Africa I recently connected with. All of us have all of this like commonality, and yet we're strewn across the globe, and no one gives a shit. None of us care. It means absolutely nothing. DeFi is 24/7. I wake up in the middle of the night. I check into Twitter. I'm looking at applications, not because I'm just obsessed, but because it's this privilege of there's always a community that is awake working on this.
You touch on some really interesting things there that I perhaps really quickly, I completely agree with you. One of the most fascinating things about crypto for me is no one candidly gives a shit what your background or pedigree is. I've seen all kinds of people pontificate, from VCs pontificate about what the stability rate should be in Maker. They have no fucking idea or never opened a CDP. Yet you have other people that are 18 or 17 or 15 years old. They're commenting on some of these forums and are posting some really interesting stuff. And honestly, no one cares. As long as people are I think in this vibrant open source community, you are sort of benchmarked against your ideas. And I think you see the evolution of how a simple idea can go such a long way. I mean, I've had the privilege of just talking like something like DeFi Dollar. These two kids were dramatic. They had an idea about creating a meta stablecoin, and then, they built it. And lo and behold, you have a protocol, and it's working, and it's And the implementation of that took months, not years. It didn't
Mhm.
require much funding. So I think that to me is most encouraging, that you have this very welcoming communities that you can just insert yourself and you, I think the Yearn ethos is don't ask for something, just build it, and don't ask for permission, just build it. And you can, right? Everything's open source. So I think for me, putting price aside, and my price prediction is as good as anyone's, right? The best barometer that I think this space has always been super interesting for me has been the level of human capital that continues to enter this space. Like
Yeah.
if you're shorting crypto or you don't have exposure to crypto, you might as well be shorting human ingenuity, because this is perhaps the most vibrant. It is the largest open source community. Ethereum is the largest open source
Yeah.
community in the world, and it's done that in a matter of like a very few years. Why? Because for the first time ever, open source contributors and developers actually accrue value by having ownership and skin in the game. And that is, to me, that something good will come out of that. Now, we may sometimes not get everything right. There's a lot of experimentation. That's fine. That's normally how like innovation happens, and you're seeing it in real time. But I think it is radically compressing because open source is compounding, right? People can copy import your code, and like the rate of innovation of open source has compounding effects relative to traditional innovation, right? Closed doors, like this cathedral versus the bazaar kind of analogy that we've heard.
Yeah.
And so the rate of which we're innovating in DeFi is this. The rate of traditional fintech is this.
Yeah.
And so now layer on top of that, oh, free flowing capital to support these protocols and liquidity on a global scale, like it's game over. Like how is fintech? How is you know what I mean? So like every time I think of really having waking up and saying perhaps I'm underexposed to crypto, and I think it's I think a lot of people are coming to that realization that for a number of reasons this is here to stay. I mean, 2017, I could entertain arguments of, hey, this is all very experimental. We don't know if it's going to work. Like even Bitcoin in 2012, but this space is quite anti-fragile. It is
Yeah.
designed to withstand attacks, by default.
Yeah, 2019 definitely felt more experimental just because like we all, Maker was working well. I think it was around like 500 million in the summer. And
Yeah.
then Compound growing to like 50 million was such a big deal. And then Synthetic was starting to really see a community form that was, growing rapidly just because everyone like believed in the mission and the exchange was up and working. But man, 2020, like once we got past the food fi stuff in the summer, it felt like that much more value got unleashed. Like you think about DeFi Dollar, I had them on Yield TV recently, and yeah, there's another example of a team where I think I messaged with one of them just a few times, and they were talking about the ideas they had, and then a few months later they came back and it was like, this is working, and you can earn like at that point it was like 35% interest on stable coins. And they built that on the back of YUSD as well. Like they, part of the mechanism relied upon that, and Curve, both of which didn't exist like 6 months before that. And so you look at all of this and you're like, I mean, if this is what's happening now, where are we going to be by the end of 21 or 2021?
Yeah, no, absolutely. I think the one of the pretty fascinating things is like as you brightly point out, like the rate by which TVL has grown, the rate by which users have grown, volume has grown for something like Uniswap or Sushi is not linear, and I think it's or synthetic synth volume, right? It's just sort of gone from 8 million to now 100 plus because they did some innovation around virtual synths, and
Yes.
now you have layer 2, which is coming this week. I'm super excited to see how that kind of catapults it to a different level. But yeah, you're right. I mean, I think it's this idea that like as soon as you unlock friction, it creates unlocks nonlinear kind of consumer patterns and behavior. And in this case, DeFi still has some friction on certain components like gas and UI and
Yeah.
just certain composability elements I think have been improved upon, but it's fascinating to see that as soon as you improve or tweak something, it just leads to a floodgate of capital. And so it's quite fascinating to see that.
Yeah, I mean, even like recently, so what was it, just a few days ago? Yeah, Monday. Monday was a really bloody day in the markets. And, maybe like what, 25% drawdown in Bitcoin and Ether at least, which is very healthy. Because if you look at a chart, everything had gone up for like 4 weeks. And it was like, wow, like we need a pullback or like we're going to have like a something even worse happen. And so you're looking at the charts there, and yeah, I mean, in the past, on bloody days, one of the things that we all learned is, wow, exchanges have such an incredible business model. They do well in good times, they do well in bad times. And as long as the space is not losing users, they're doing well. Well, you start looking at the volumes. I think that Uniswap, I thought that was the first time they broke a billion in 24-hour trade volume. So 1.3 billion that day. Curve did over 300 million. Synthetics, I think, did about 45 million, which I thought was a record day for them as well. And then DYDX did like 125 million. So all I'm pointing out is that when we've pivoted to DeFi, where everything then becomes open source and community owned, at the end of the day, that's a bunch of flowery language to say, I own a portion of the fees that are getting pumped out by all these different applications. So like I'm an LP in Uniswap, and like I looked at 1.3 billion, and you can see, you're like, hell yeah, like I made some good fees today, like from that. And I'm not a whale. Even as someone who's, with smaller amounts of money, you can recognize that. And then it's like, okay, there's a drawdown in the market, but the mechanisms are working, which validates, why we're all here. And that's what keeps more and more people coming back.
Yeah, totally. I had 2 points to add to that. I think one of them was in March, you really tested the fragility or the anti-fragility of the system, right? You had what was 4,500 simultaneous liquidations when the price of ETH compressed 50% in like a span of 2 hours at 3 a.m, like US time. So everyone was asleep.
Yeah.
So you really tested the robustness of Maker as a system, which is kind of the underpins all of DeFi, I think, by being just sort of the central bank. And it worked, right? Okay, there were issues with how the auctions and the liquidating the collateral, and so you had shortfall, right, where people liquidated their collateral, but that was more of an issue around keepers in the system and the way the auctions worked. Nonetheless, like the system worked, it survived. There was a 2 million, I think, shortfall, which is de minimis relative to the level of liquidations. There was no bailout. The system continues to thrive, and there was no like the politicians just have to step in. That to me really was the first test to say, okay, if this system can absorb this shock so violent, then it really kind of fulfills. This anti-fragility concept of these financial systems that by design are transparent. You're able to see risk in real time. It executes like a predetermined logic that if your collateral ratio falls below X, you automatically get liquidated, right? And so to me, that wasn't the case in 08. In 08, in the financial crisis, you didn't know Lehman or Merrill or some of these banks. You know the health of their balance sheet. You didn't know the level of exposure that they had to derivatives. It's not that derivatives are bad per se. It is the level of transparency that is an issue, because you didn't know ING had all these, collateralized mortgage obligations and derivative products that if there was a 2-3% decline in house prices in Florida would cause a cascading effect of liquidations and defaults. But no one had the ability to kind of understand that risk. Now you do, right? You in real time, you're able to see the average health ratio of the Aave money market is X, and it is distributed across all these different assets that have different volatility profiles, and so is Maker, and so is Compound. And so for me, that is by far one of the most fascinating things of this space. This idea that you can have and assess risk in real time, not in a static manner, but in real time, you're constantly able to monitor risk. And so Of course, we need insurance products, and so like what Cover was doing was, or still is doing, is quite fascinating, where the market is telling you how risky a particular protocol is by virtue of like pricing the cover and no cover, like claim and no claim tokens. That creates like a credit default swap, right? Saying, hey, Curve is A grade, AAA, and Compound is AAA, but like this experimental new protocol that just launched is C or triple B, and then plug in Barnbridge there and say, okay, tranche it up. And then I'll take the, I'll combine different like AAA and different and B and triple C and just tranche it up and earn yield on that. Why? Because if there's a default, if there's a hack, then I'm on the line. So yeah, when I talk to my banker friends, I told them, imagine a world where you're able to perfectly price collateral 24/7, 365. And their eyes glow. They're like, yeah, that'd be kind of nice. That's it. Well, that's DeFi. And then they start rambling about, well, if that's the case, then we could do this and that and that. And then I'm like, yeah, exactly. So what are you still doing in your bank? Why don't you just come over to DeFi and build? Because it's fascinating, right? Mark Cuban, we talked about this before, but Mark Cuban was just tweeting yesterday, which by the way is fascinating. He's come a long way in his crypto journey. He's now tweeting about DeFi and Aave, which I never thought. Like, I've just been happily surprised. But he's telling us, hey, look, these derivative products, like the system is closed. There's a lot of risk. I'm saying, sure, Mark, I'm not going to disagree with you. There's still a lot of risk. And the surface area of DeFi is expanding in multiple dimensions. And I don't think we're pricing risk correctly. There's a lot of like integration and composability it's a double-edged sword, right? You're only kind of as strong as your weakest link. Nonetheless, like the ability to price a derivative product is really fascinating because you understand risk. See, this is the thing. You don't understand risk in the traditional financial world because things are not transparent. In DeFi, everything is transparent on chain. So you're able to understand risk way better than in finance. And so you're able to create derivative products around that, right? So that is, to me, a big paradigm shift.
Yeah. I was just bringing up the tweet here that you were referring to. Oh, there we go. Let's make sure there we go. Audio's good now. Okay, there we go.
Yeah.
I mean, it's fascinating, to see how they're starting to weigh in on this. Like I was kind of surprised as well, just to have like a Mark Cuban like weighing in on this. And I remember like hearing him talk about Bitcoin at least years ago, and then actually hearing him mention Ethereum was like, whoa, oh, Mark Cuban knows what Ethereum is. Does that change our whole space? No, it's just proof that there's really there's other very intelligent people who garner a lot of attention, and this is a good thing. You have someone who, if they're talking about it, there's other folks that might start paying attention. And at the end of the day, people have to be reminded over and over and over again until they finally say, you know what, I've heard about this too much. I'm gonna deep dive into like what exactly is going on here.
Yeah, absolutely.
Santiago, so I think the follow-up to all of this, and probably like where we can start to wrap up the conversation, is what do you think is the next most important step in DeFi? And then I'd love to talk more about any other theses that you believe may play out in 2021. But like, I guess like what, it doesn't have to be what will happen, but what you wish would happen as, I guess, over the next few months.
Yeah, well, it's a good question. I think as I put on like my Oracle hat, I think we've last year I would characterize as like core building blocks and money Legos being constructed and testing it. It's sort of like a trial run of what's to come. You had what is no longer chump change. You started the year with about like a couple $100 million of value at risk. Now that's up to 20.
Right.
I think as I think like if capital is always efficient and finds the right most productive places, it will continue to flow into DeFi in a very meaningful way, in a non-linear way. I think it is incumbent on the industry and us to really figure out best risk management solutions. That is options, that is derivatives, that is insurance, to really apply that to better risk management. I think is going to be a big category. If you look at the evolution of most industries, you really need insurance as a backbone to support a lot of the activity, like whaling expeditions and transatlantic expeditions, as an example. I think the insurance space is interesting. I think we experience it because we're first and foremost core users of these protocols, and then we invest. So we have a lot of value at risk on chain, and so for us, we are perhaps one of the largest, if not the largest, buyer of cover on Nexus. So, but that's not enough. We're gobbling that cover. But we say, well, we could probably figure out different alternatives like options and other risk management solutions to figure out impermanent loss or just to hedge on chain. And so I think that space is very vibrant. That I think ultimately will push us through to new levels of like TVL. The other, I guess, like the second part of your question, thematically, another thing that I'm excited about is I think I'm not a maximalist by any stretch of the imagination. I think there's a lot of interesting activity happening in other blockchains. We haven't been very focused on them historically, but I think the level of activity in Polkadot is interesting. If Parachain's kind of launching in end of Q1 or Q2, there's a lot of value there. Ultimately, that for me says, okay, there's going to be a lot of stake dots. There's going to be a lot of transfers of value. So, I'm not prepared to for me, it's hard to deviate from Ethereum because it has the strongest community and it has the most activity. But I do think that building this connective tissue between blockchains, I think perhaps will be interesting. Where a lot of value will be like building. It's the analogy of building railroads to connect the East Coast to the West Coast. Back in the Monroe Doctrine, there was a lot of value there was a lot of demand that drove that. And so I think that something like Ren or something like some of these bridges, I think will be quite fascinating. Like Moonbeam and Polkadot is making EVM compatible parachain. It's just everyone can plug into that. So I think ultimately we'll see I think Haseeb from Dragonfly his analogy is quite apt in how urban development, you have metropolis like New York, the hub, and then you have Queens and Brooklyn and the Bronx and Jersey. And so I think there's a lot of flow and activity between these cities. Not everyone lives in Manhattan, but they'll kind of at varying points in time come in. And so I think that will be exciting. And then layer 2, I think in a matter of days we'll see. But I've been testing layer 2 in synthetics. I know you have too. I think. To me, that is explosive. I mean, you're going from I've said it again, but I'll say it again. It's this is going from dial-up internet to broadband. In the friction points that you've had historically that have been the criticisms of Ethereum and certain DeFi applications, I think largely go away. Where the deficit that you've had from a UI UX kind of goes away with layer 2.
Yeah. There was a 10-second demo video I did of Curve recently. It's Curve with ZK Sync, and it's just a demo still. It's on testnet, and man, the responses that I got to that, it was a reminder people are so hungry for this. And with synthetics going live, with Optimism, I mean, I've used Loopring. We've all used Loopring, and once you try it, you almost forget it because most apps, of course, are not on L2 yet. So I've trained myself to be patient and to not expect that. But Matt Feinstone, who's I think the head of BD at Loopring, every time I talk with him, he reminds me of something to try. And so they have they have an AMM now, and there's some liquidity mining program there. So I already have used Loopring. I know what it means to click and see it, confirm the transaction within a few hundred milliseconds. But when I went to the AMM, I'm oh yeah, that's right. So I have some LRC and I need to trade it to ETH so that I have a 50-50 liquidity provision. And I do that, and 5 seconds. So I do it, transaction's done. 5 seconds later, I click add and add both tokens into that liquidity provision. I'm so used to going through multiple approval transactions and looking at gasnow.org and pricing it out and bidding to pay less gas, but a high enough price that I get it through fast enough. And we've all become accustomed to that. And here I am, I'm just click, click, click. 20 seconds later, I'm all done. And I'm there's no way, even for those that have never even tried this, that they'll be able to turn away from this now, because now everything is there that you want. And synthetics with staking, I'm very grateful for that program, but most people are paying what, $20 to $50
20, 30,
for
yeah. There's a whole subset of users that have been just precluded from, unfortunately, interacting on chain. And again, it goes back to this: you're unlocking a lot of friction that will create nonlinear consumer behavior and patterns. And so, yeah, I think I'm not surprised if synth volume goes 5x or 10. I mean, just skyrockets from here. The other component from our vantage point is much more institutional flow into crypto, like much more, for a number of reasons. And then in particular, I think a lot of traditional TradFi will start building bridges into DeFi because their users will demand it. And it's theirs to lose. It takes one large bank to integrate with DeFi, or one large, even centralized exchange to interact with DeFi and allow farming and allow for staking to catalyze an entire FOMO of these institutions. It's not so much that it's a nice to have. You're going to come into a state of the world where it's a must have. If you don't have it, you're going to lose customers. I think that's going to be happening this year more so than ever. And I think that ultimately will push us to just seeing much more activity on chain.
So am I to credit you for turning Mike Novogratz into a DeFi bull? Because Mike is an incredible storyteller. I mean, he really has done a lot of good for both Bitcoin and Ethereum over the years. He's just people love to hear this guy, talk about like what he thinks the future is. But I was a little let down, like in 2018, 2019, I felt like, Mike's gone silent on Ethereum and, like what the heck happened? But I feel like he's really come out in the past 6 months. And I'm saying that because you guys took investment from Galaxy, right? Yeah. So just kind of curious, like, honestly, I feel like I'm searching for like a funny anecdote because I think he's like one of the funniest people alive, while also being one of the most successful people alive.
Yeah, I think he certainly is a figurehead of this industry, and he carries a lot of weight, and we're incredibly grateful to have. They did invest in the fund, and I think for them it was this growing desire to have exposure to DeFi earlier this year. And when we had a lot of conversations with the team at Galaxy, they came to the conclusion that it's a very interesting space that they didn't have enough exposure to, and so it took them a while, I'd say, but I think that has been helpful because now we have a lot of conversations with them about. I think part of the reason to partner was really to get them just more up to speed and on all things DeFi, because that's all we do. That's the only thing that we do is DeFi. So I think he goes now on CNBC and evangelizes, which is great, right? He has a megaphone, and I think that's it's great for us, I think. So yeah, I'm not sure if there was a funny analogy there, but
it's great. If you can pass along to Mike, we'd love to have him on Yield TV. And then I'm going to ask Mike, how do I get on CNBC with you? Because you guys clearly need some DeFi Dad tutorials. I feel like it's talk of price, this and that. I'm like, whoa. Let's show you how all of this works.
Let's do a demo on CNBC. I mean, I'd be down for that. Just compare Robinhood and compare Argent or compare Zapper, and like let's go one-on-one.
Show the boards they have where you've got the guy like drawing, all over it. And Santiago, I have one more question for you. You clearly appreciate history. You clearly have studied what civilizations and the history of finance. What books would you recommend reading that would help one to better understand and appreciate what's going on in DeFi?
Wow. Yeah. I mean, I think it's so multifaceted, so I'll just ramble a couple. I think anyone that's in crypto should read The Sovereign Individual. Incredible that he predicted this 20 years ago, and it's on point. So The Sovereign Individual, more philosophy, more just macro transitions. The Bitcoin Standard is a must. I think it just helps you really understand money and how it works or how it doesn't work, and the properties of Bitcoin and Ethereum and other crypto assets. So those are the two. As it relates to financial history, one of my favorite books is or an author just is Ron Chernow. He's a biographer. He's written like some incredible stories about the House of Morgan, which is the evolution of like JP Morgan as a bank. And no, I'm not just saying that because I worked at JP Morgan. I actually think JP Morgan was at the front and center of like really creating an entire like financial industry back at the turn of the century. And so that was interesting how they built it. And then there's also like the Carnegie biography about sort of and so that those two are really good. The other author that I really like is now actually turned crypto is Neil Ferguson. So The Ascent of Money. He is an incredible biographer and just a great historian, financial history. And so The Ascent of Capital, I think, is a really good book. And crypto Twitter. I mean, crypto Twitter is just I think we're seeing. You go back to certain. Yeah, I'd say like I would like to go back to like a year ago or 2 years ago and or watch YouTube videos and say what were people saying about Ethereum then? What were people thinking about like DeFi?
Yeah.
And that it's always nice to kind of do a post-mortem of what people were saying then and what people are saying now to give some perspective.
Yeah, so much has changed.
I don't know. What do you have any favorites that maybe
Oh man, so I started this book lately that is called, what's the name of it? This is on Audible too. It is Devil Take the Hindmost.
Oh yeah.
It's fantastic. Like a history of speculation, and it's fascinating. It like kind of frames up even like the tulip mania as it tells you at first the common stories of it being a mania, but then it almost poses the question that it wasn't a mania, and that like that based on the price of tulips and the demand, like if you believe in efficient markets theory, that like all of this really wasn't that nuts. It's just the system got so far ahead of the technology I think that was required for people to transact more efficiently and more like transparently. That was one. Honestly, this one like less related to crypto. I think it was a Neil at Delphi that was talking about it. I read, oh gosh, where is it? The Psychology of Money, which was just more like it's like 20 plus short stories about money, kind of like one of those books that reinforces. I mean, it reinforces a lot, but one of the things I loved to reread about is that idea of wealth and being rich and like really understanding like just how messed up people's minds are, like at distorting like reality and not remembering like what was the goal, like the goalpost keeps moving. I do it myself with my own DeFi portfolio. When I get here, I'm going to take profit. Okay, well, I have a really nice round number right now, which is one of the dumbest unsaid things that people do, where they're like, I have 100 of this and I want to keep 100 of that, or I have a 500 of this token and I want to keep that. And you're like, what are you doing? Like, take profit, and let
on that point. It's such a good point. I think Soros has a really good book on reflexivity. I forget the title, but it is fantastic. I mean, I love Soros. I think he's one of the smartest investors. Put aside ego and just, this is sort of the truism around, do you want to be right or do you want to make money? And I think reflexivity is so very much accentuated in crypto. So that's a good one that I would definitely recommend. And just generally, game theory is so applicable to these systems. Like you talk about algo stable coins and the game theory behind them. And there's a really fascinating.
Yeah. Oh my God.
There's a really good book. I study game theory, so I really like this game Finite and this book called Finite and Infinite Games by James Carse, I think. Really, really good. It touches on like this idea: are people playing iterated games or finite games? And you invert that, and of course, like how to play poker or how to play iterated games. Algo stablecoins are iterated games until they're not, until the music stops, and so there's just a lot of psychology and game theory behind it. So that's probably one of my favorite ones. There's just so many. I mean, Nudge is really good by Richard Thaler, a behavioral economist. Like everything in investing is game theory, is human psychology. I'd say it's less about finance; it's more understanding human psychology. And game theory, at least it's been how I think about investing.
I mean, it's like I was thinking to end now, but I have to ask you then about algo stablecoin. So if anyone wants to learn about this, and this isn't financial advice, we're not endorsing algo stablecoins because they're really high risk. You can lose all your money on it. That being said, I did like a 3-4 minute video with the Defiant News on it. I'll link it in the show notes. It's for this DeFi 101 series. But so Dynamic Set and Empty Set are like two of the biggest names or at least they were. There's other big names now. Like there's just so many of these. But one of the interesting parts of this is dynamic set and empty set being the original dynamic set having forked. They have this coupon system. So if you're new to this, when price is above the dollar, you have an expansion period, and the idea is you're increasing supply for those that have bonded their ESD or DSD to the DAO, and that will hopefully bring the peg back down to $1. When you're below, it's not an involuntary contraction the way that Ampleforth at least used to run it. I don't know if Ampleforth still does this. The supply becomes less by people voluntarily burning their ESD or DSD for coupons to redeem above $1 with a premium, which at this point is like on
45, 54%.
45, 50, it's huge. But there's no saying that since there's an expiration of currently 30 days on both of these. So when someone buys this, they're betting that they'll be able to redeem that, which is also a dogfight. Once you get above $1, you have certain folks using bots. So there's maybe it goes above $1 for just a few hours and you don't get to redeem. You're trying to get rid of those coupons and make that return before they expire. What's going on, Santiago? Like, what do you think? It's been nuts to watch it, like lately.
Not to tip our hand too much, because of course it's our strategy. But maybe I'm saying this to incentivize other people to act and coordinate. So maybe I'm just all psyops. So it's very right. I mean, I think how you described it. So at the end of the day, all these systems, all they are they're some have varying flavors, but the ESD, DSD, and basis cash, they're zero collateral, or at least in their first variation, which they purely just rely on coordination and game theory to incentivize people to restore the peg. In periods of expansion, you increase supply to then bring that back down. In periods of contraction, you issue this incentive to buy coupons, and then new participants, you require new participants to come in and bid up and do this pull to par trade to bring it back to this peg. In theory, the first couple of cycles should be more volatile. As market cap expands, the deviations from the peg should the frequency or the amplitude of each sinusoidal cycle should dampen for a number of variations. More capital, more more pool capital, and some the LP pool might just dampen the severity of those cycles. Of course, in the early days, we saw huge spikes in ESD and DSD and basis cash. I think that's normal. But yeah, we're actually interesting in I think very interesting 2 cycles for ESD and DSD. So both are in contraction cycles. They're trading at 60 to 70 cents on the dollar. There's there's less liquidity in the uni pool, which should in theory push make it easier for incremental capital to push that price above $1. But what we've seen is, especially in DSD, so you have 10, 15 days for the first batch of coupons that were purchased to expire out of the money. And if they do, that will be the first time. ESD, I don't think, has ever had a contraction where coupons expired out of the money. They have, I think, 30 days to expire. Meaning if the price is not of 1 for a sustained period of time and a couple epochs, then you don't redeem, and then you lose. It wipes out that coupon holder. In theory, so what could happen, right? In DSD, there's I think 84 million of coupons that have been bought. That's a lot to clear, but certainly possible. So what needs to happen is the price to stay above 1, either in a very sustained manner or just expand much more above 1. Because I think the way you calculate per epoch how much debt can be cleared or coupons can be redeemed. So it's going to be interesting because there is a subset of participants that didn't buy coupons, but they have DSD and might just want to sell it because they bought it at 30 cents or they bought it at 50 or 60 and might just want to sell it at 90 and $1. So that we've seen the price of DSD come close to 1, and as soon as it hits that 95 to $1, there's a whole range of bots that are just selling. So that's problematic for coupon holders. So not to ramble too much, but I think this cycle is very interesting for the third point that I wanted to make, which is you're in a bull market, and the opportunity cost of having this is higher, right? Why should I long and do this pull to par trade of DSD when I just long DeFi assets or Bitcoin or Ethereum? And so at the end of the day, you're competing for capital and new sources of capital, and there's only so many incentives that you can tinker with. But when ESD launched, it was like August, where it was like we went through this bear market. And so from a portfolio construction standpoint, none of this is financial advice, but like it's sort of like an interesting stablecoin that has some like unique like convexity, and like it has this sort of like equity kicker to it. But yeah, you're right. I mean, it's so this is why I think this cycle coming up for EST and DST are going to be pretty critical. But funny enough, we moved away from pure zero collateral to partial collateral, which is, wait, you're telling me that we're just going to implement what the central bank does? But because they're now minting funds for Treasury to like have this essentially a Treasury to do monetary policy and step in when there's big deviations. So look, to cut it short, I mean, I'm happy to talk about this at length. There's just so much to unpack, but I'm glad you brought them up, because thematically, I think there will be one or two that really emerge as a pure, decentralized, censorship resistant stablecoin, and I think we need it, and it's going to be big. So it's either going to be one of these or one that we haven't seen.
We don't have short-term, memories. A few months ago, everyone was freaking out about the Stable Act, and then you forget about it, and I don't know for sure, but I'm betting if someone calculated how correlated like ESD, DSD, other algo stable coins are, I bet it's near zero. Like it's got to be around zero. I don't know if it's inversely correlated, but I noticed just in like 6 months, it's algo stable coins were getting a lot of attention, I think, as we were ranging or in a bit of like a drawdown. And then we had this 4-week period of like nonstop green candles in the market. And no surprise, it was right around the time after the last expansion, I think, of empty set, which I think coincided with dynamic set. So it's a crazy game to watch. Like I would say, I'm clearly not overexposed. I'm comfortable watching it to death, but I recognize there's got to be some huge money right now that is fretting, what's going to happen over the next few weeks, because that coupon system. The thing that kills me about it is the coupons. The people that are burning ESD, DSD, or whatever stablecoin for a coupon, those people are playing by the rules. Those are the people that are actually helping, this mechanism to potentially work. And those who are not burning are potentially going to cause the mechanism to fail. And that sucks. Like, that's why that expiration of 30 days. But as far as I know, with empty set V2, the expiration's going away. Is that the same with dynamic set?
I think they're also tinkering about improving the coupon architecture and design to address this point. Because you're right. I mean, I think if all these coupons were to expire out of the money, or a big chunk of them, I think it might be a point of no return where it just degrades. It degrades a lot of trust in these. I mean, a lot of that capital destruction at the end of the day, like, turns people away. But one of the things that I'm monitoring closely is the secondary price for coupons. So you're able to sell them in a balancer pool, and it has been, I think, hovering around 27 cents to 30 cents, which tells you. So that is the proxy for the level of anxiety in the coupon holders, because they're willing to sell you the coupon at 30 cents on the dollar. There might be a better look. A strategy would be, if you're a coupon holder and you think you're not going to be able to redeem, why not sell now at 30 cents? Use that capital to either buy DSD to make up for that loss, right? Maybe. But you're right. There is this tension between someone who didn't buy a coupon and just wants to do a pull to par trade versus coupon holders. But I think ultimately, in theory, people should converge around this and coordinate around this idea that we should, going through an expansion and making sure that we can clear these coupons is probably beneficial for the health and long-term durability of the system and confidence. But
do you think then, is it the community then that will attribute to the success of one of these algo stable coins? Because one of the challenges I've recognized is just there are so many forks that have emerged and such like minor tweaks. And it took me by surprise. Like I wasn't really, I knew enough about empty set, and then I saw dynamic set launch, and dynamic set has, again, this isn't an endorsement of it. I have no exposure to it, but I was like, hey, like there's clearly some success here. I'm going to define it as the fact that the market cap is growing and that there's a lot of activity. And if you look at the number of holders of DSD, it was actually a much higher number than ESD at the time. But the market cap of ESD had grown so much. So I guess all I'm trying to say is, without us trying to be oracles and pick winners and losers here, like, I mean, is that what the answer is? We go back to community. Community is what drives the success of every protocol, or is there something else that we've missed that could help drive that success?
I would certainly agree. Like, I think the premise that communities really drive a lot of value is we that is a core principle of our investment framework. They're really, really smart minds, and if you just want to learn about game theory and monetary policy, just jump into any of these discords, because the caliber of the discussion is quite high. It's econ 505, and so I think both. I think ESD has a lot of really strong minds, DSD as well, and some other projects too that we're involved with. So I think it's attracting a lot of attention and like smart minds. I will say though, I think the ultimately communities can do a lot of things, right, and can iterate, and there's been a lot of proposals, right, to change the coupon mechanics and a number of other things. But there are multiple different camps of these stable coins. I think it's been, not to single one out particularly, but Frax has been interesting. Full disclosure, we invested in it. I think behind this idea, perhaps a market-driven, like partial collateralized system was worth exploring, and growing into confidence. Initially, you let the market dictate how much collateral should be backing the stablecoin. So it's almost like a fractional reserve system, right? But you start really high because you want to have, the peg stable. And as soon as you have conviction around that, I think over time, and as the system matures and people get confidence in it, and when there's more liquidity, then that collateral collateral ratio should go down over time. And I think that is an elegant design. I think it encompasses some really interesting properties that by design is just very different from ESD or DSD, perhaps less scalable at first, but at the end of the day, what are you trying to optimize for? Are you trying to just optimize for this game theory of playing cycles and just quasi Ponzi games, or are you actually trying to make a very stable coin? My core philosophy with these stablecoins is, with usability comes stability, and so what happens if you don't have a stable coin, which seems like then it won't be added as collateral in Maker or Compound. Then it won't be usable. So that's what I mean about usability, right? You need these things to be onboarded as collateral types and actually really kind of be a unit of account, the same with the DAI is, or USDC is. They have their own set of problems, 100%. But at some point, guys, we need to be around the peg to make it usable. Otherwise, it's just going to be fun and games until it's not, and the music stops. But it's very promising, I'd say. Very early, very experimental. It's not for everyone. Yeah. None of this is financial advice. These are all different strategies and things that I've thought about, but it's really, really, truly buyer beware. I mean, these are very, very experimental things.
Oh, yeah.
Spiral out of control.
Yeah. And it's worth noting I actually worry less about something truly going to zero. Well, I guess there's like a smart contract bug, which could compromise all funds. But the thing I worry about most, we've all had friends, family, peers, colleagues who, they go in, they say they understand the risks, and they sell out. They are like having like a mental breakdown, and then they view it as having been scammed by some system. And you're like, I mean, if you're going to play with fire, you might get burned. And that's what happens with these algo stable coins. when we were writing up this DeFi 101 series for the Defiant, it was not the plan to do a video on algo stablecoins. It was a very like minor topic, but I was near the end of writing, and I was like, like we got to write one on algo stablecoins. This was just in the past month. There was one script I hadn't written, and I'm like, this is such a huge topic. I know that a year from now, we might all like laugh at ourselves and say, I can't believe we kept entertaining this. But I just look at the mind share that is in these communities, and I'm like, I just don't see a way that this isn't going to continue to pivot until it finds a mechanism that is sustainable. So we need a censorship resistant stable coin. And at the end of the day, like that's my pitch on algo stable coins is try to ignore the quasi Ponzi games that go on, even though clearly that's what draws a lot of people into it, and recognize the long-term value is that we need yet another censorship resistant stable coin, because DAI has, I still believe that DAI is like a miracle of DeFi, but it has its downsides. Synthetic USD is incredible for how it's holding the peg now and the liquidity behind it, and the success of synthetics. But again, there's always room for something else. Like we can always use another censorship resistant stable coin and possibly have a basket then of all of these that hedges against the downside of one of them failing. Santiago, anything else you wanted to share? Like, just want to remind folks they should follow you on Twitter here, of course. They can check out ParaFi.capital. Like anything you wanted to share about the fund in general, just if entrepreneurs are watching, potential builders in DeFi, like how can they get a hold of you?
Yeah, well, first of all, I mean, this has been a great discussion. I hope it was useful for folks. I'm always available. You can find me on Twitter. That's where I live. Hopefully, I think it is incredibly exciting time. We sometimes you hear from folks, hey, it's too late. Look at what the price of Bitcoin is or Ethereum. I should have jumped in 2017 and 2019. Yeah. But ultimately, I think my view is you just step back and you say, we're so early still. I mean, crypto Twitter is just deceiving because everything that you see touches crypto. But you look around, and I think we're coming up into a very interesting transition. It's so early. So any founders out there, any people that are on the fence at Brex or Stripe or some of these companies, Facebook, whatever, or just interested in the technology, you'll find that it's a very welcoming community. What you do here is fantastic, all the educational resources. And similarly, we try to be helpful to the community by being users and by just first and foremost, just being available. And there's multiple ways that we can help. But yeah, look, I think it's a very welcoming space, particularly Ethereum, particularly DeFi. And so it's incredibly exciting. There's so many things that can be built, and it's factorial, right? Now that you have synthetics, now that you have Aave, there's so much integration that hasn't been explored between these systems. And so, yeah, I would just encourage everyone who's on the fence to reach out. We're always around and available and looking for smart founders, passionate founders and builders.
Absolutely. Well, if you hang out just a minute, I'm just going to close out the show. And if you have any other questions, happy to talk through it. But everyone, thanks for joining. As always, we won't have an episode tomorrow, but Friday we may have a special episode. Depends if we have some. I'm always looking for product releases, so I'm going to keep my eyes open. And we may do a new segment called the Week in DeFi, which is really just like 10, 15 minute like wrap up summary of everything that happened in DeFi over the week. So might keep an eye out for that on Friday. Otherwise, we'll be back next week. And please, as always, subscribe at tv.zapper.fi. You can try Zapper to track your entire DeFi portfolio. Just connect your Ethereum wallet. You can connect all your wallets and bundle it so you get a full view of your entire DeFi portfolio. And then don't forget about the farming opportunities under the Invest tab, as well as the DEX aggregator under the exchange. So anyways, thanks so much, Santiago, for your time. And everyone have a great week, and we will see you soon. So bye.
Thank you.